Hope everybody's doing well. And in terms of people that have been to our webinars before, warm welcome back. And for those that haven't been to one of our webinars before, a huge welcome as well. Effectively just a short explanation of what we're going to be doing today. So we've got a very special guest in Nick Garner, who's a stamp duty specialist, who we're going to be really treated to a lot of educational content about stamp duty and the different reliefs available, which a lot of people, I'd probably say, are not aware of, even if they're experienced investors. So we're in for a treat this afternoon. But just before we get into that, just want to give you a bit of a recap, bit of an introduction back into Fabric and who we are. So Fabric are a whole of market consultancy. We work whole of market. So we help investors buy property here in the UK, whether that be in the secondary market, it could be in the new build space, or we work in asset management. So in the secondary market, we work in anything from a 2-bedroom, 3-bedroom house to a HMO, house of multiple occupation, or a block of flats, for example. New build is typically within city centres, apartments typically, and then asset management is whereby we joint venture with high net worth individuals, family offices and institutions to effectively joint venture on deals more in the commercial space, and that's on a bit of the higher end. So that's a little bit about Fabric, and we'll give you an opportunity of how you can connect with us, and if you'd like to have a chat and see how we can help you, we'll give you that opportunity a little bit later on. So today we're going to talk about stamp duty, like I mentioned a little minute ago, and then at the end we're going to have an opportunity for a Q&A where you can ask Nick or myself any questions that you've got. If you want to pop them into the chat as we're going through the webinar, we can pick them up at the end and then go through a Q&A session. So without any further ado, I want to introduce you to Nick and let Nick take the floor. So over to you, Nick.
Hi, everyone. And Matt, thank you for having me. So just to introduce myself, I've been around property for quite a long time. I was in property sourcing, and an opportunity came up where I could get involved in doing reclaims. And many of you have heard of uninhabitable property reclaims. Well, anyway, I was doing quite well with those until that door closed. And latterly, I've been doing a lot of things like mixed use claims, and also kind of getting into advice, working with property traders, things like that. What I want to do with the presentation, I suppose, is just use it as a general structure. But the other layer in this, I guess, is just my experience with things, stuff to watch out for, philosophies, or at least strategies that you may want to pursue. And with all those in mind, hopefully this will be helpful to you. So I think if we go to the first slide, there we are. I'll speak plainly. I'm sure you'd like me to do that. The conveyancing solicitor that you trust to handle your conveyancing may be a great conveyancing solicitor, but not necessarily a great help with things like stamp duty. And I just get a steady flow of people basically just crying, saying, what happened? My solicitor gave me completely the wrong advice, and I ended up paying this huge amount of stamp duty, and I want to get it back. And then we go through that process of sorting it out for them. And generally speaking, I'd say 60% of the time, they come to me crying, as it were, and I'll just say, well, look, you've got to do this, this, and this. Off you go. And then they sort it out themselves. And sometimes they need my help in a more kind of involved way. But the thing about stamp duty is that as much as your conveyancing solicitor will protest, they'll sort of try and I'm generalizing here, by the way, some solicitors are amazing, but maybe it's just me and the fact that I end up dealing secondhand with the ones that are just troublesome. But generally, the way it seems to go is the solicitor will say, will act as your tax agent. So in other words, when you're buying the property, they'll say, here's your calculation for stamp duty, go and pay this at completion. And then you put your money, you lodge the funds, obviously, and then they go off and do it. And if you're unquestioning, then they kind of behave like it's their responsibility, not yours. But it's a self-assessed tax. It's not their responsibility. And we know this because when they mess up, they say, oh, I'm sorry, I'm not a tax expert, in this case, etc. They don't even apologize, in fact, because that would suggest liability on their part. So the problem is that you've got conveyancing solicitors who don't really know what they're doing when it comes to edge cases. And then on the other side of the coin, you've got HMRC or Revenue Scotland or Revenue Wales or Welsh Revenue Authority. And as a general rule, these organizations, the land tax agencies, I will call them as a placeholder, they never lie. They never lie, but they don't tell the whole truth. And I get this constantly. And for example, this morning, I had a woman come to me and she bought a guest house. She wanted to make a claim in it. And they said she was timed out. But the truth is she's not timed out because it's not, what she's trying to do is reclassify her property from residential to non-residential because of it being a guest house. And she can claim up to 4 years from the date of purchase. But because of the way HMRC have done this, and they've done this, they tried this on me in my early days and on my clients, and it's just a kind of repeated thing where the half-truth is, the truth is, no, you can't claim. The real truth is, yes, you can, but we're not going to give you that bit of information, allowing you to then cite the relevant legislation and go ahead and make the claim. So the point is, conveyancers are in this domain are relatively incompetent. HMRC and Welsh Revenue Authority and Revenue Scotland will always tell the truth. The administrators I've found have always been very professional and agreeable and so on, but they're part of a big machine, and the rules that they work by is the legislation and the case law. So they're not your friend. They're not going to give you free advice, and they're not going to tell you the whole story because actually it's in their interest not to, for purposes of extra tax take. So my guess is that if I look at the total domain of land tax, and I think what percentage of self-assessments are probably incorrect, I would say it's going to be like 10 or 15%, I would have thought. So anything that's kind of edge case, which is either potentially mixed use or non-residential, any of those kind of things. Previously, multiple dwellings relief was often misinterpreted, but that's been abolished now. But anyway, getting back to the main point, it's on you. That's it. Don't expect your solicitor to be helpful because they'll tell you they're not tax experts. And then the next layer down is, okay, well, all right, I need a tax expert. But then very few accountants really know much about this. And this is also annoying. So I'm not saying I'm an expert as such, but I know quite a lot about stamp duty, and I've got a website full of information about stamp duty, and I've got a couple of books that I've written which I can give to Matt and he can distribute to you if you want. You just drop him an email, or however Matt wants to communicate with you. He can give you a copy of those. It's PDF. One book is about 1,000 pages. A bit of a read, but it's not for reading, if that makes sense. It's for using as a reference guide. Now, the other thing is when things are arguable, it's not the way things play. Well, we talk about this in the slide dealing with inquiries, but I just want to talk about a general principle, really, which is that what matters is the correct self-assessment. So your conveyancing solicitor says whatever they say, but ultimately it's your responsibility. And the question is, what is the correct one? And then and if it's an arguable situation, classic being you buy a property and it's got a non-residential element. Maybe you bought a garage for some reason, or a bit of land or something that's non-residential. It's arguable one way or the other. So what really matters is, am I making the correct self-assessment? And so I guess people like me can help answer those questions. Or you do your own homework and look online, do your research online, and understand the key principles and so on. And then you can make that judgment call. But relying on a conveyancing solicitor who really doesn't want to know and doesn't understand isn't that helpful to you. The other thing that's very important is this idea that you may be able to get favor with HMRC if you do certain things. That's just wishful thinking. So a classic is where you've got a contentious situation, or arguable situation. You could pay this much stamp duty, or you could pay this much stamp duty. And the question is, what's correct? Now, one argument is that you pay the stamp duty and then you reclaim it back later. Another one is that you just simply self-assess one way or the other, and then you wait to see what happens with the inquiry, which I'll be talking about in more detail later. In my opinion, having been around the block with this and having done about 450 cases now, there's no love here. It doesn't help that you pay the money out and try and get it back. It really makes no difference. Just what matters is the correct self-assessment. And once you have confidence in that, then do the self-assessment. Pay the stamp duty, the land tax, the LBTT, the LTT, whatever, pay accordingly. But if whatever you decide to do, make sure you've got a plan, that you've got an argument. Because if you don't, then everything gets very troublesome later on, which I'll talk about later on. So I think that's the main thing. It's just doing your homework and keeping your eyes open and being streetwise about these things and taking personal responsibility for it, because that self-assessment is you declaring to the authorities, this is the stamp duty that I have to pay. Anyway, on to the next slide. Right, so the reason I'm talking about all this stuff now, by the way, instead of like how to save loads of money at this, that, the other, is because I want to make it very clear that there are issues, there are ways of dealing with the issues, and it's not free lunches as such. It's just about being sensible with things. So this could be Welsh Revenue Authority or Scottish Revenue Scotland. Now, what I find in general, just dealing with each of the organizations. So HMRC operate a process now, check later policy. And what that means is if a case is procedurally correct, they'll just pay. If the case involves a refund of, say, more than, I would say, £40,000, £40,000 to £60,000 refund, they are more likely to open an inquiry based on your refund application. So the thing about inquiries, I'll talk about what an inquiry is and so on, but generally they'll pay, and then there is a 9-month period, and in which they can make an inquiry. And if they do make the inquiry, it's usually month 7. So my view is that it accrues some interest. So what happens is, well, I'll go back up one step and then I'll talk about HMRC inquiries in more detail. But okay, so HMRC pay up. Welsh Revenue Authority tend to ask an awful lot of questions, then pay if they're happy. And the same with Revenue Scotland. Just HMRC are the ones that tend to pay. And then you think, great, it's all wonderful. I got my money, but that's not necessarily the case. And this goes back to what is the correct stamp duty, and is my position solid? So the way it plays out with HMRC, for instance, and inquiries is that, let's say we have a mixed use case. That's a classic. So Matt's got an example of one of these later on, and it's a house like I had one the other day, for instance, classic ordinary residential house. But downstairs was a former pharmacy, a Boots pharmacy. So the whole downstairs has been gutted out. Now, on paper, it looks like a house. Thus, the conveyancing solicitor said, well, you've got to pay residential rates on this, residential rates of stamp duty. But arguably, whilst it is basically a house, the ground floor was used for commercial purposes for a very long time. And so my job is to argue this point and in this reclaim. But if you're buying the property and you can see, well, it was an old pharmacy, et cetera, then maybe you should just assess as non-residential. But again, it's all about the details. So, all right, now we have the next part, which is the self-assessment goes in, or the reclaim is made. If in generally speaking, it's 7 months, as I said. And what tends to happen then is that because the interest rate on outstanding stamp duty is at 8%, the interest costs rack up. So not only have you got the demand for repayment or payment of the stamp duty, you've got this extra interest component. Anyway, so the stakes are a little bit higher. And generally the way it goes is that you get a very polite letter just saying, we'd like to get some more information about this case. Then it goes to a case handler. They will accept email communication, which makes things quicker. They're usually very polite, civil, sensible people. It's all very nice, except it's very high stakes. And then there's usually some back and forth, and then they will make a decision. And typically it'll be a closure notice, because they disagree. You can assume that HMRC would bias their opinion against the taxpayer. So assume that you get a closure notice saying, no, you got to pay up. And then the next level up is where you appeal to the HMRC solicitor, who's supposedly independent and probably is relatively independent. And if that doesn't go your way, then you can go to the first tier tax tribunal. Typically a hearing is 20 minutes. It's free to dispute cases there, so there's no cost. And you could self-represent. Like many cases in first tier tax tribunal are self-representation where the taxpayer has won. So it's not like you have to have a barrister. It helps, but if you have a solid argument, then and it's researched and you do your homework on these things, you can fight these cases. One of the landmark cases was PN Bewley v HMRC, property developer. They won the case, even though they got numerous things wrong with their case. The judge found that, in fact, the property they bought was not suitable for use as a dwelling, and therefore the principle of not suitable for use as a dwelling due to being uninhabitable basically came into play, and that carried on till October 2nd last year. So when other case law came through. So the main point about all of this is that the inquiry process is relatively straightforward. Well, let's go back. So let's take that example where you've got the property and there's a mixed use element. And let's say it's a London property and it's arguable that it might be mixed use, might not be mixed use. So you do your self-assessment, say, well, it's mixed use. Fine. They do the inquiry. What you're playing for is the stamp duty plus the interest. And then the next question is, well, what's the likelihood of inquiry? It's an interesting question, because if you get your the typical process is your conveyancing solicitor will say, no, it's residential. You will have done your homework and said, you know what, I think it's mixed use. I really believe this and I have justification for it. then if you have an email exchange with your conveyancing solicitor and you say, look, I want to do this, it's my responsibility, then conveyancing solicitor will generally back off because they're off the hook. They're not responsible for you. So then you can instruct them accordingly and off you go. I think there are two layers to all of this. Working with property people, they're generally hardcore, and the first question is, what is the likelihood of inquiry? And if it's just you doing an assessment, self-assessment with no information, probability of inquiry really increases depending on the sum of money. So in my experience, HMRC will not inquire on a case, not always, but generally not inquire on a case where there's about £6,000 or less involved in the case. In other words, the stamp duty liability is 6,000. Above that, then they make inquiries, and obviously the bigger the number, the more likely the inquiry. The probabilities go from under 6,000 to like 10% likelihood, something like that, or even less, up to, depending on what it is, but typically that would be it if it's a mixed use thing. And all the way up to like 60-70%. But you got that layer of risk, and then the next layer is, right, if they do inquire, what are the odds of winning? And then when you assess the probabilities here, you add up A and B, obviously, and then you can come up with a view on it. And you may decide that actually it's worth the risk, and that you put your stamp duty that you've either received or saved in a high interest account somewhere, and you wait it out till the inquiry period, the 9 months, has elapsed. And if no inquiry, then fine. This kind of stuff is hardcore, and if you behave carelessly, and that's a very fancy way of saying, if you're not telling the truth, or if they find, if you're not being sensible and careful, and if you behave in an unjustified way, then they can issue a fine. But the thing is, if you've done your homework, then it's not careless. If you've got a property with a non-residential element and it's arguable, well, it's not careless. You've got a reason for doing it. If you've got a probate property and you're a property trader and you go for the stamp duty exemption, and they come back and say, well, excuse me, we'd like to, et cetera, not careless. So it's really down to risk and reward, I suppose, if you're a hardcore property person. And the issue now, of course, is because of 5% additional rates of stamp duty, and if you're a non-UK resident, of course, it's an extra 2% on that, so 7% on the entire value of the transaction, plus the residential stamp duty. It's actually very high stakes stuff. And if you can reclassify a property to non-residential, or if you can get one of these exemptions, of which there are not that many, the stamp duty liability difference is huge. So residential rates would be X, and typically for a London 600,000 to 800,000 pound property, something like that, non-residential rates would be about a third. So big difference. And just to wrap up on this slide, and reinforcing a point really from the other one, is that it's on you. And if you're streetwise and you know how the system works, then you can work it in your favor, and there's money, which is good. But it's all about being sensible and careful and respectful of the system, and then you should be okay. What doesn't help is just going, well, I did it before, it worked. Well, okay, but do you know anything about what happened, why it worked? So homework. All right, what's the next slide, Matt? Okay, mixed use. I keep talking about this because it is one of the ones that is, it's a very interesting one here. Okay, so most transactions are just plain vanilla. It's a block of flats. It's a house, something like that, or it's land. If you're a property developer, oftentimes you're going to come across brownfield sites, and there will be, or maybe it's a garden or a house that, or let's say a split title on something. Good example is a good example of something that's ambiguous is, let's say you buy a plot of land. Was it someone's garden? Was it agricultural land? If it was someone's garden, then you're going to be paying residential rates of stamp duty on that, because its status at the date of purchase was someone's garden, and then you hived off the title and you got yourself a building plot. But if it was agricultural land, then it's non-residential, and therefore you're going to pay a third of the stamp duty or whatever, depending on the purchase price, obviously. So that's one example. Another example is a big house. So some of you may be interested in buying big houses, great, with big gardens, paddocks, those kind of things, woodlands. So I've got a case at the moment. This guy has bought some woodland, a house with some woodland, and the question is, do we assess as mixed use or not? And the answer in his case is absolutely, because there's a footpath running through it, it's public access, it doesn't benefit the house, and so on and so forth. So any of those kind of scenarios are interesting. Another one might be, for example, you might be working with a vendor who's got a number of properties in their portfolio, and they might just have a garage. Oftentimes people have bought garages to rent out and lease. Let's say it's a garage and it's somewhere away from the house. It's not exactly with the house. And the garage, they might be selling it for 10 grand or something like that. But because that gets thrown into the deal with the big house or the big residential property you're buying, and it's a linked transaction, in other words, the big house, the little garage, they're linked together, then the whole transaction becomes mixed use, and therefore you're paying non-residential rates of stamp duty. Now, if you're buying six or more units in one transaction, which I'll talk about, I think, a little later. Well, I'll talk about that in more detail. There, you can get non-residential rates of stamp duty on that, but I'll go through that in more detail then. So the main point being that if there's something that does not benefit the dwelling that you're buying, either in the single title, so it could be, it doesn't benefit the dwelling, and or it's for commercial benefit, then mixed use. And there are lots of edge cases, and therefore there's lots of case law going into this whole topic in the first tier tax tribunal. So remember, we talked about inquiries and so on. The place where disputes get sorted out is first tier tax tribunal. And then if they're still not sorted out there, they go to the upper tribunal, but that's very rare. So that's mixed use. And it's one of the only areas where I think you can play the game and get the free lunch, just to use a phrase. But again, it's all about doing it right. So you're paying the correct stamp duty based on the legislation. And if that extra, if you're talking like an £800,000 deal or something, £1 million deal, then you're talking about not 9%, but about 6% in the difference in terms of the amount of money down. And remembering that stamp duty is something that you have to pay basically up front. So it's going to hit your cash flow, which is an issue. And if you're borrowing, then it becomes quite a large amount of money relative to the cash down on the deal. So it starts to really matter. The other one is uninhabitable property, which I don't think I've done a slide on, but I think I just want to touch on that. That used to be the big free lunch. And the way that worked was, because of P.N. Bewley, self-representing people, it meant that if a property was too dangerous to live in and needed more than some renovation or repair, that could be assessed as not suitable for use as a dwelling, and thus subject to non-residential rates of stamp duty. And as I say, I processed hundreds of these things. But there was a case in the upper tribunal with a family called Mudan, and what the judges found was that if a property has fundamental defects, or what they declared was that if a property has fundamental defects that cannot be repaired, in other words, the place is fundamentally unusable, cannot be recycled, can't be renovated, then in that case, it's not suitable for use as a dwelling. So what they're doing is they're saying, well, it has the characteristics of a dwelling. It's going to be a dwelling in the future. Once it's renovated, therefore it is. And that killed off uninhabitable property. However, there is an appeal underway, and it will be heard fairly soon, I expect. And the appeal, without getting too nerdy on the topic, basically, there was an appeals court hearing, and it dealt with this particular topic of what is suitable for use as a dwelling with different legislation, different body of legislation. It wasn't to do with stamp duty, it was to do with leasehold enfranchisement. But the point is that this whole thing is open and it's under appeal, and things may change. My guess is that if you have a property where the boiler's not working, the place is generally in unmodernized condition, I don't think you would have a case. If, on the other hand, it is pretty much derelict, as in really in dangerous condition and just not suitable for use as a dwelling at that point, and maybe had not been inhabited for some time prior, like some months to years or whatever, then I think the door may open on those. The good thing is you've got up to 4 years to claim on those kind of properties. So if you have any of those, just keep an eye out, or maybe contact me. I can put you on my mailing list, and I can let you know what's going on with the appeal once it's heard and which way it's all going to go. So that would be my emails on my website, landtaxadvice.co.uk, and it's nick@landtaxadvice. So if you want to get on the mailing list, do. All right, let's move on to the next slide. Right, okay, so this is an interesting one in that you go, great, okay, I'm not going to buy 6 units in one go. But the thing is, you have linked transactions and you have connected purchasers. So the way this plays out is that, for instance, imagine you have connected persons buying a property. Maybe it's shareholders, it's family members, something like that. So I came across an interesting one where a family were buying a lot of a group of properties, and each of them bought a property, I think 1 or 2 properties each, but they were all connected persons, and they had their own companies, so 1 property, 1 company, etc. And just a family pooling their resources. But the point was that they bought 6 properties from a vendor, and thus the whole thing was transacted as non-residential for stamp duty purposes, which is nice. But it's not the typical case, obviously. However, if you're talking, for instance, terraced houses in Middlesbrough or someplace like that, then it starts to really make more sense that you could purchase these properties as connected persons. So then you're into the whole thing about, well, how do you structure that? As I said, it could be, I would need to do some more research on this. If someone actually came to me and said, look, I want to do this. Family members, that's straightforward. Company stuff, I suspect it would be something to do with shareholders, common shareholders within a company pooling together, buying something or a group of properties in a single transaction. But the point being, to make it linked, you'd need a common seller, the same seller, same group of buyers. So that's that one. Not that exciting, but it is something to consider. What's the next one, Matt? Next slide. Okay, now this is quite interesting.
Just before you get into this one, Nick, I've just noticed we've had a couple of hands raised. I just want to let everybody know that if you pop your questions in the chat, we will address all questions at the end, if that's all right. So, yeah, sorry to jump in there, Nick. I just see hands pop up.
All right. Well, I see I've got that 9SY. It's the new lingo. But anyway, on the slide, you can see there's a typo there. Anyway, right. So property trader relief is a really interesting free lunch, as it were. In stamp duty, there are, I think from memory, there are about 28 or 29 reliefs and exemptions. But of those, the only ones that are interesting are, well, there's two buckets within that. There are the ones which are just, okay, that's standard stuff like first-time buyers relief. Relief from stamp duty is where somebody is subject to a court order, so people getting separated or divorced, that kind of thing. Property being inherited. There's no stamp duty relief on that. I mean, there is stamp duty relief on that. And those are different reliefs, but that's not very interesting in this context. The ones that are relevant to anyone in the property game would be, going back, taking from the top, mixed use, the bulk purchasing, and property trader relief, and then those and assessing as non-residential, and maybe some others will come to me. But let's talk about property trader relief, because I get quite a lot of people talking to me about it, and I think it's the most interesting relief of all for property people. And when I say relief, just to be very clear, there's two buckets here. There's reclassification. So mixed use is a reclassification. It's where it goes from A to B, and thus your liability goes from A to B. A relief is like a discount. So reclassification, you can claim if you've overpaid, you can claim within 4 years. If, on the other hand, it's a publicized discount, which is effectively what a relief is, then you've got to claim within a year, within 12 months. And that's a very hard line. So if you go over it, that's bad news. And I get this a lot from people who are just like coming to me well after the event. And this has all been tested thoroughly at first tier and I think upper tribunal. The whole thing about missing deadlines. Anyway, property trader relief. The way this one works is that if you're a property trader and you buy a property probate or broken chain, and you work within the constraints of the legislation, which I'm going to talk about in a minute, then you pay no stamp duty. So that's great. So then the question is, how does it all work in reality? So the qualifiers are that you mustn't spend more than £10,000 on refurbishment, 5% of the value of the property, up to £20,000. So that's one big thing. And the other one is qualifying what falls within the quota or not. So this is where it gets ambiguous. And curiously enough, there have been no court cases in first year tax tribunal or upper tribunal going into the meaning of refurbishment, which is kind of weird and interesting in that you would think, because it's a very ambiguous area. And side note, what I'm doing is I'm working more and more with property traders on this stuff. So they assess as 0. That's great. I take a small percentage. I'm here as their insurance policy. I make sure that they stay within, we all stay within the terms of the law. And if HMRC come knocking and inquiring, I'm there to protect you. Otherwise, I lose my fees if you have to pay up. So I got skin in the game, as it were. Now, just to take it kind of chunk by chunk, the first thing is the refurbishment cost. So it turns out that you can spend an unlimited amount of money on legal costs. So, for example, let's say you buy an apartment, it's a probate, it's on a 40-year lease or something. You can extend the lease, you've got to pay your money. Well, none of that is included in the quota, the money, the financial quota that you have to work to. So that's great. So legal costs, unlimited. Repair, unlimited. And making safe, unlimited. So making safe is a really interesting one, because the way that would play out, and remember that a lot of this is very untrodden ground, but you may have heard of the Housing Health and Safety Rating System. It's a system that local authorities use when they assess a property and they go, well, it's dangerous, we've got to issue a prohibition notice or whatever. And it's the foundation for describing what is safe or not safe. So it's used within the Home Fitness for Habitation Act, the Rent Reform, the Rent Reform Act, I think it's listed in there, loads of places. So what one would do is, with this probate property that you've just got hold of, and remember it's probate like you bought it from the personal representative, so the people dealing with the deceased person's estate, and you would get an assessment done, health and safety assessment done, and they say, well, the electrics aren't safe, the carpet's not safe, it's a trip hazard, you've got unsafe staircase, you've got this, you've got that, the plaster, you've got damp on the walls, you've got plaster which may come down, all of these kind of things. They're all safety, they're all to do with making safe, and therefore they're not part of the quota. And if you account for all of this stuff sensibly, in other words, and this is where like getting into the fundamentals the fundamentals of the project is quite important. So instead of just accounting for it as money out, I spent this on this and this and this, if you account for it by labeling it as either legal costs, for instance, making safe, refurbishment, repair, then if HMRC come and have a look and they look at your accounts, then you can show them that you're working within the £10,000 refurbishment limit that they impose, £10,000 to £20,000 limit imposed in the Finance Act 2003. The key with refurbishment, what it really means is making something better. So let's say you've got probate and the property's a wreck. Kitchen is unsafe to use for preparing food because the HHSRS inspector said so. Right, you're going to put a new kitchen. Obviously, you're not going to put in a 50-year-old kitchen. But what you can do is put a like-for-like kitchen in. What's unwise is building an extension that's going to cost you more than £20,000. So in other words, it's anything that improves the property. And a good place to look when you're thinking about all this is with buy-to-let landlords, capital expenditure over expenses. So money which can be offset against expenses would be, or works that can be offset against expenses would be things like repairing the boiler, or if it's broken, get a new boiler, replacing the boiler, things like that. And that's a good framework to look at when thinking, is this refurbishment making better, or is it just, is it one of the other buckets? It's very ambiguous, all of this stuff. And that's why I think I can help a lot of people to stay on the right track. And I've written a lot about this. So what you can do, of course, is get the ebook from Matt. He'll email it to you and read up on it. And if you want to just DIY this, help yourself. If you want my help, great, I'm here too. Now, the other area for property trader relief, there are a few different exemptions. So there's probate, there are things like, for example, buying an employee's property, I think, and some other ones that are pretty edge case like. And then there's broken chain, which is quite interesting. But I think probate's the big one. Broken chain, just to explain that a little bit, it's where a sale has fallen through, and it could be, for example, imagine it's me, I'm buying a house, and Matt is the person I'm buying the property from, the next property on. I got to sell my house, and for some reason Matt gets a better offer and I'm left hanging. So maybe there would need to be a memorandum of sale in place, and say Matt's gazumping me because he's got an amazing house and everyone wants to buy it, and he's prepared, someone's going to spend more than I will spend on it. Therefore, I'm stuck. My chain is broken. I got to sell my place. Someone swoops in and says, look, I'll buy this from you, etc. So that's broken chain. And it could be any reason. There's nothing in the Finance Act 2003 that says this reason for broken chain or that, just any reason for a broken chain where a sale falls through. So I think it's an interesting one. I haven't really got my head around it. Probate seems to be the one that people come to me asking about the most. But of all the exemptions and the reliefs and so on, I think that plus obviously mixed use, I think those are the really interesting ones. Anyway, what's next, Matt, on the slide-a-thon? Okay, we talked a little bit about variations earlier, regional variations. As I say, England, the HMRC offer the process now, check later stuff. So I won't go into that in any real detail. But the other thing that's interesting is the legislation. Well, interesting to me. I guess it's interesting to you too, because you're here. The legislation. The Finance Act 2003 was the original stamp duty legislation, and Welsh Revenue Authority's legislation and Scottish Revenue Scotland's legislation, the names of the legislation I can't remember offhand, but essentially they're cookie cutter with small variations. So, for example, variations that I know about are in England, there's no multiple dwellings relief. Boo. That was abolished on June 1st last year, and arguably it was because there was too much abuse of it, and well, it's just more tax take for the government, isn't it? So anyway, Wales didn't abolish multiple dwellings relief, but they've come up with a slightly different flavor, and it is where you can either claim subsidiary dwellings relief, or you can claim that it's not an additional dwelling. So in other words, you buy two properties in one transaction. You can either go for claiming that the second property isn't an additional property, or you can, let's say if it's an apartment within, let's say you've got a house and it's got a little annex or something, and it's classified as a separate dwelling. You can say, well, okay, this little apartment, the granny apartment, it's a subsidiary dwelling, therefore I'm not going to get charged additional rates of stamp duty on that. So it's a bit around the houses and back, but the point is, it's the Welsh version of multiple dwellings relief, not particularly attractive financially. Scotland, from what I understand, still has multiple dwellings relief, but Scotland is quite devolved. So they all have the basic same legislation, but variations. And the big variation with Scotland, I would say, apart from the rates, so that's the land tax rates vary per territory. Approaches to claims and just general conduct varies a little bit, which I talked about earlier. Inquiry periods is an interesting one. So in England and Wales, you've got 9 months. So you do your self-assessment, and if you self-assess on the day you purchase, then it's 9 months, 14 days, because you've got to submit your stamp duty return within 14 days. So 9 months basically for that. But for Scotland, 3 years. Also, the rates. Also, there's another area which is quite ambiguous, which I'm working on a couple of cases on, funnily enough. So if I did this again in a couple of months, I would be able to tell you. But it's uninhabitable property for Scotland. Now, in Scotland, they don't honor, I'll use the word, they don't recognize the first tier and upper tribunals. They actually have their own tribunal system. And looking at the court cases there are very few court cases, and there's nothing there around uninhabitable property, which is interesting. So I wouldn't be surprised if that whole area is a bit open and a bit arguable. And as I say, I've got a test claim, so I'm going to see. So this client has got a dilapidated property up in Scotland. Beyond that, I think they're all basically the same. So once you get the main idea on one of these areas, then it's kind of the same for the rest. So what's next, Matt? Yes. Okay, now this is for non-investors, but I get these questions constantly. And it's a very difficult one for buyers. So I'm telling you about this because you may know somebody and it's a trap and they should know this too. So the classic is where somebody gets a bit of money. Let's say they get an inheritance. Young person gets a bit of money from somewhere and does the right thing, gets into property investment. Great. So they buy an £70,000 wreck in Liverpool and they get their hands dirty and do the place up, become a landlord at 19 or 20 or whatever it is. Fine. Then in the future, they decide, right, it's time to buy my own home. I've been, I'm doing whatever I do, and that's great. So then they buy a property for $500,000 or something. They want to buy it. Now, the first thing that will happen is the conveyancing solicitor will ask, do you have an additional property? Yes, I do. Okay, you have to pay 5%, £25,000 on top of the residential rates of stamp duty for your new home. Now, the usual thing is they'll go online and they'll see that they can claim it back if they sell the additional property. So they go ahead, they buy the property, and that's when the horrific moment of realization comes, when they realize they can't claim that money back. And the reason is that they did not dispose of their main dwelling. So the way this additional stamp duty stuff works is that if you have a house, a home, your primary dwelling, and you buy another home and you sell off your first property, your first home, then, and let's say there are two scenarios here. You want to buy a new place, great, $500,000, super duper, wonderful. You've got your existing property. You can't sell this property A, quickly enough. So you just have to buy property B with continuing to own property A. You sell property A within 3 years of buying property B, fine, you can reclaim. Now that's different to, I've got a buy to let and I sell that within 3 years. It wasn't your primary dwelling. You're not going to get your stamp duty back. So the fix on this one is that little buy to let, if it's purchased through a limited company, then it's not in the person's name. So if you imagine the young person, they're buying this property, the £500,000 property, if everything's in limited companies, then it's not in their personal name, therefore they do not own an additional property. Even it's all counterintuitive because you think, well, the limited company, they have control of the company, thus they have control of the property. Yes, but technically the limited company is the owner, not the individual. Very important distinction. So the way, I'm just saying, this is just to share with anyone who knows someone in this situation. Whatever you do, dispose of those additional properties, whether you sell them or transfer them to a limited company, you can do either, but you're disposing of them. And the law says disposal, not sale. So you're disposing of, and then you go ahead, buy your new home, and you don't get hit for additional rates of stamp duty, and you don't have this horrible trap where you end up paying it for some reason because you're listening to your conveyancing solicitor and then realize you can never get it back. So that's just for anyone. It's a public health warning, I suppose you could say. And as I say, I get this a lot. One other quick thing to say about this is that I've talked with a couple of mortgage brokers who I trust, and they've talked to various lenders who they deal with. A lot of lenders will be okay with you borrowing to pay the stamp duty. So let's say you've got the property in your name, transfer it to a limited company. You have to pay the stamp duty within a certain period, but if you have the cash, great. If you don't have the cash, then what you shouldn't do is you shouldn't hold off on paying, but sometimes these things happen, life gets in the way. And in theory, what you can do, and in practice, in fact, you could borrow on the buy-to-let if there's enough equity in it, and then the proceeds from the loan will pay for the stamp duty. If you're late in paying, you've got to pay the interest and a fine. It's either 100 or 200 pounds, depending on how long. But as long as it's within 12 months, that's the big thing. And then that's it. You've paid your stamp duty, you've done your thing, and on you go. What's the next slide? Yes. Looking forward. This touches on a personal topic, I suppose. Some of us are optimists and some are pessimists. Generally speaking, it's better to be an optimist and deal with the bad stuff as it comes. And in my view, the tax noose will just tighten till it cannot tighten anymore. And so when that point comes, it starts to cause lots of self-harm to the government, to tax take, to sentiment, to their chances of being re-elected. And that's when you reach your equilibrium. And long term, do I see stamp duty reducing or being abolished? Certainly not with Labour. I'm personally very anti-stamp duty. I think it causes paralysis in the market, the property market. It stops people from trading up or trading down easily. And therefore, you end up with lots of single people, couples living in huge houses, which are basically just a store of wealth when that house could be lived in by a family, for instance. It stops people moving around the country for work opportunities. It's just generally quite a destructive tax. But anyway, I don't see that changing. And the thing that I'm a bit worried about is with mixed use. So there's this thing called apportionment. It's mentioned in a consultation document which HMRC issued about a year and a half ago, I think it was, or the government issued about a year and a half ago. And they were looking at abolishing, obviously, mixed use, multiple dwellings, which they did. But the big change that may come through is apportionment. And that's where, for example, take the mixed use scenario. So you got the big house worth £2 million or £5 million, whatever. And then you've got the commercial element and it's £100,000 or £20,000, whatever it is. And so what apportionment means is that they would value the non-residential element separately to the residential element instead of bundling it all together. So depending on how gnarly things get with tax take, I see that being one of the next things to go. And the other thing I'm seeing more is, over the last number of years, is just more inquiries, more poking around from HMRC, just more scrutiny. And I think that's a culture that's changed since Labour have come in, broadly. That seems to be what's going on. So you got that, and then we've got all of the Rent Reform Act stuff. It's very difficult to decipher is it Property 118 or 8 or whatever. There are certain websites which are just like, I may as well go and shoot myself today. This is just, why would I even think about being a landlord? And it's all doom and gloom and stuff. And the reality is it's not quite that bad, but it's not wonderful either. landlording has its issues. Rent Reform Act has lots of unknowns. I think I think property trading gets more interesting as landlording gets less interesting. And the reality is that the net number of properties for rent, I mean, there's build to rent, which is a different thing. But if you talk about everything else, that's definitely in decline. So I think property trading very interesting, and the exemptions for that. And I don't see those going in a hurry, but I do see HMRC paying a lot of attention to that because there are an awful lot of bullish, naive, optimistic property traders who just think the future will take care of itself and I don't really care. And then they get a knock on the door from HMRC and then they fall foul on a technicality and then they're hit with a fat stamp duty bill. So read up on that stuff, know what you're doing, but if you do, it's a great free lunch. The other thing is just market recovery. So I was talking to Matt earlier about this. I don't really know. Matt's the trader. I'm not in the middle of this by any means. And I don't know if now is the great time. I suppose it is because interest rates are higher. There's more stress in the market. If you've got the money, it's a great time. But then once interest rates start to drop, which they've begun to do so, things loosen up and then that leads to opportunities, stuff coming up, more stuff coming up. And if you're looking around for deals that work, mixed use. I keep saying mixed use because it can work, but it comes in all sorts of flavors, which is a thing. And as I said earlier, just the HMRC, they're turning the screw, but in the end, they have to follow the law. So they may say and behave as they do, but for example, their guidance is generally unhelpful. It's kind of misleading. It's difficult to follow in many, many cases. And it's not legally binding to them. So, of course, it's going to be the way it is. But the truth, there is always a kind of foundation truth to all this matter, which is the law, the legislation. They're the rules by which we all play. And HMRC's position may be distorted a little bit because of the way they behave, but in the end, everyone has to follow the law. And believe it or not, judgments in first-tier tax tribunal, upper tribunal are generally quite sensible. Occasionally they go a bit off-piste, but generally they're sensible. And I would say that they bias the taxpayer 45%. So 50-50 is totally neutral. Little bit on the HMRC government side of things. Certainly, that's what I saw with uninhabitable property. But overall, it's still a reasonably fair system. You just got to be able to navigate it. And it starts with and it starts really with my very first point, which is paying the correct stamp duty, knowing what you're looking at, doing it right, and then you're avoiding trouble and you're being a better property person for it all. And I think that's the last slide.
It is. Yep. Thanks very much, Nick. Really appreciate that. That's some really helpful information. And I'm pretty sure I can speak on behalf of everyone that yeah, you gave us a lot there. Some maybe too much, to take in all one go. But
well, it's recorded, isn't it? So you can watch bits back if you want.
Yeah, one thing I was going to say, of course, you're going to get the recording on the back of this webinar, and of course we'll share that out. But also, I'd highly recommend having a one-on-one chat with Nick to discuss any specific details, any deals that you're looking at, to get his opinion. Obviously, highly experienced and will steer you in the right direction. So, before we get into the Q&A, as I promised earlier, we would go into a couple of very quick examples just to give a little bit of context to a couple of different stamp duty rates that would be sort of out there. So this first deal here, he actually says deal 2, but it's actually deal 1. So there's my error like yours, Nick, there. So deal 1 is Rover Road, and that is a 4-bedroom HMO. This is a residential property and would be applicable for residential stamp duty. So kind of most type of buy-to-let investment property this falls under. So The purchase price on this one is 250. The residential stamp duty, as you may know, has two rates for UK buyers and also for non-residents. So there's a 2% surcharge for non-resident buyers on top of the additional rates of stamp duty. So the UK rate is 15,000. Non-resident rate there is 20,000. This particular property is a 4-bedroom HMO, and it provides a 28,000 per annum net income, which gives a round net yield of 8%, including all of your closing costs, a stamp duty included within that, alongside your legal fees and licensing. So that's an example of a residential stamp duty. And if you're interested in talking about these type of properties, you know, I'll give you a chance in a moment to pop in the chat if this is of interest to you.
Can I add something to that?
Yeah,
Can you
sure,
go back to that one? Right. So a couple of things just to say. You remember we were talking about an uninhabitable property. So this would be your classic case. This is probably much tidier inside than one might otherwise think. But you know, it's just a plain old HMO. But these were the kind of properties that you could assess as not suitable for use as a dwelling if it was unmodernized. But this is modernized and ready to go, I assume. So you know, it's a different story. But if that was in Blackpool, for instance, and it was a guest house, then it would be assessed as non-residential for stamp duty purposes. So a lot of those properties probably make very good HMOs, I guess. And if it was formerly a guest house, then yeah, non-residential rates, which would be £2,000 or something. It would be very, very little money on that.
Low, yeah.
Anyway, on to the next one.
Yeah, no, appreciate that. Yeah, perfect. All insights. Great. So this is deal number 2. So this one is an example of a mixed use property. So what Nick was referring to before, which I'll give you obviously a chance to actually give an explanation in actual you know, practice here. But you've got obviously the commercial element downstairs, and then you've got the residential element upstairs. So there you've got 2 commercial units, a shop retail unit here and another retail unit there, with the 4-bedroom apartment upstairs. The purchase price on this one is 275. So non-residential stamp duty on this one, a little bit like what Nick just mentioned there with the 250 on the slide previous, is 3,250. So if you compare that to the residential rates, there's a significant saving when looking at non-residential or mixed-use property. So that's a very interesting point when you're considering stamp duty. The net income on this one is 25,800, which provides a net yield of 9%, including your closing costs. Is there anything you wanted to add on this one at all, Nick?
Well, actually, I wanted to ask you a question because you know much more about this kind of thing than me. So, if you're buying a mixed use with retail below, is it much more hassle than just buying straight residential?
Good question. To be honest with you, not for the actual owner, because you either have a property manager in place, or with commercial property, you have a full repair and insuring lease, which puts a lot of the onus onto the actual tenant themselves in terms of, you know, making sure the property is kept in good repair. They also deal with the utilities and the management, and they effectively make sure there's no void. So they'll pay you the rent on time every month, whether there's a tenant or not. So it's a really nice strategy, this, but it doesn't matter either which way because the property manager's in place.
Well, there you go. And again, just on the mixed use point, that's obviously mixed use. Obviously, if your conveyancing solicitor said, well, there's residential there, it's residential, then they would be wrong. It's mixed use. That's all. So very good.
Brilliant. Okay. And so referencing what Nick said before about potential apportionment, they'd obviously be assessing the upstairs potentially different to the downstairs, but that's yet to come into play, and would highly recommend Nick's sort of suggestion of getting onto his mailing list as well, so that, you know, any sort of updates in them regards, you'll be first to know.
Yeah, the uninhabitable property thing. It's a big one.
Exactly. Perfect. Right. So Q&A. So before we get into this, I just think it's a good opportunity for everybody just to pop into the chat if they would like a copy of Nick's ebook. So if you would like a copy of Nick's ebook, if you could just type ebook into the chat, we'll make a note of that, and then we'll make sure that's issued out to you. No problem at all. So that's the first thing that's there. If you would like a consultation arranged with Nick, if you just put Nick in the chat. And if you'd like a consultation with myself to discuss any of the properties we looked at just a moment ago or one similar, put my name in the chat as well. So while we're going through this Q&A, feel free to pop any questions or, ebook, Nick or Matt in the chat, not a problem. So let's get into the first question, and naturally a lot here for you, Nick. So I've got a question here which says, multiple dwellings, what are the rules now? Are there still circumstances where you can still claim SDLT? What's the criteria, number of units? How is it calculated?
It's dead. It's no more. So that's that. Yeah. The only side note to that is that if you do purchase 6 or more properties in a transaction, then the whole thing is assessed as non-residential for stamp duty rates, stamp duty, for stamp duty, and then that way you pay a lot less stamp duty. So yes, it caught a lot of people out, and it was very annoying. But there you go, it's no more.
Perfect. On the back of that, I'll ask you a question. So could you explain the difference between multiple dwellings relief and the linked transactions? So 6, I guess, in the non-residential method of stamp duty.
Okay. Well, multiple dwellings relief would be where you buy 1 or more properties, or you buy a single property, but it's got 2 distinct dwellings within it. And that might be a big house with a lodge on it or something, or it could be a block of apartments. It could be 3 or 4 apartments, and each one is a separate dwelling. And the way that was calculated, and remembering it's still going in Scotland, and a flavour of this is going in Wales, or carries on in Wales, but the way that would work is you take the total transaction value, and then you divide by the number of dwellings, and then you pay the stamp duty per dwelling. So let's say you've got 2 properties, £1 million. You pay the residential rates of stamp duty on half, on $500,000 on one property and $500,000 on another. And so that's how you save money, because, as you know, because of the slice system, I suppose you call it, the bigger the number, the bigger the percentage of stamp duty you pay. So over 975,000, I think it's 12%, and so on and so forth. And this was a way of just keeping within the lower slices. And as I say, it's no more. So the other way this can be structured is, for example, if you've got a group of people, or you're an individual, whatever, but you're buying 6 properties in one transaction, what happens there is the whole thing, the whole lump, as it were. Let's say you buy 6 properties and it's £3 million, so $500,000 each. Then what happens is your stamp duty is paid on non-residential rates for the £3 million, which is on average about 5% for the whole lot. Whereas if it was assessed as residential, you'd be paying the stamp duty on £3 million total, and the average there, I guess, would be 10% once you factor in all the different slices and so on. So that's the difference. And the linked bit is, if you've got a vendor selling a block of property, then you could work with other people to act as purchasers, and then you could work together through, say, a corporate structure or something like that, or if it's family, and then you will buy whichever bits of this property portfolio you choose. And as long as it's more than six or more, then it's taxed at non-residential rates for the total transaction value.
Brilliant. Okay, cool. Thank you. So I've got a question here. So say the value of the property is at 70% residential and 30% commercial. Will that still fall into commercial property stamp duty rate? To what extent of residential versus commercial will it be considered commercial?
Right. So you're kind of drifting towards this idea of apportionment. The reality is it could be worth £10 As long the law doesn't specify the value of the non-residential element, it just says, is it residential non? So a classic is the big £5 million property with an acre of commercially farmed forest that's just lumped in with some big forestry tract. That's non-residential. It's probably worth £15,000 at most, and that bit of non-residential will make the whole transaction mixed use, and the owner will save £500,000 or whatever it is in stamp duty. I've seen some cases where the numbers get absolutely huge, and the commercial element is really worth very little relative to the price of the residential property.
Brilliant. Yeah. So in essence, it doesn't matter what percentage, as long as there's a commercial element present in the property.
Yes, and just to double down on this point, it's either it's commercial, like it's for profit. So if you think about the key principles here, because it helps understand all these use cases. So for example, it's either not for the benefit of the property. In other words, it's a thing that you've got, doesn't help the property, and it's non-residential in nature. So that could be some unused land that was never built on. It could be a industrial unit that's now no longer functioning. It's just an empty old factory, basically a shell. Any of those kind of things. If it doesn't benefit the dwelling, then, and it is non-residential in character, then mixed use. Or if there's a commercial arrangement, a legitimate commercial arrangement. So the classic would be, let's say you're buying a valuable apartment or something like that. There are car parking spaces. There's a lease on the car parking space. You can't park your car there because it's been leased out. So when you bought the place, you also bought the lease, and you had to deal with the lease, and you can't plonk your car there. That would be very arguable in favor of mixed use. So that £6 million apartment could be taxed at non-residential rates because you got responsibility for the thing. You're making £100 a month out of it, but you can't use the parking space. It's been leased out, and the parking space, it's worth £10,000 or something like that.
Got it. Okay, cool. You've got an interesting one here. So in a joint purchase, how does the residency status of each buyer affect the application of on the non-resident surcharge? So I guess
yeah. I've come across this many times. So
one's UK, one's overseas, I'm guessing is the question.
Yeah. So we get this quite a lot. So an example would be, let's say it's a overseas investor, and they're doing a joint venture with a UK purchaser.
Yep.
And they set up a limited company together, and one of them is non-UK resident for tax purposes. Property is subject to the 2% surcharge. So and you see this rule, you see this logic in various things, like, for example, additional properties with married couples. So if it's an economic unit, like let's say a limited company is, if one of them is, then the whole thing is. So that's my understanding. I'm pretty sure that that's the case, because I remember, I haven't looked at this for a while, but I'm pretty sure that that's the case. And it's the same with additional properties. If you've got a husband and wife, and she's got an additional property somewhere in her name, and they want to go and buy another property together as a married couple, then they've got this additional property they have to deal with. But let's say, for the sake of discussion, the new property is in his name, still doesn't matter, they're an economic unit. And the same principle, I believe, from memory, the same principle applies to limited companies, for instance.
Brilliant. Yeah, I guess you're saying there, all parties need to be UK based or not have an additional.
Yeah, exactly.
Is the simple answer there. Cool. Okay. Another question here. I think
one thing I will say, by the way, just sorry on that.
No,
if a property is assessed as non-residential for some reason, or mixed use, because it's the same net result, then all this business about additional rates of the non-resident 2% non-resident stamp duty premium that you have to pay, none of that is applicable if you're paying non-residential rates of stamp duty. So this is why going for mixed use gets even more interest, especially if you're a so that deal that Matt had with the mixed use, the one with the nice juicy 9% yield, great. If you're non-UK resident, you're not paying the extra 2% on that one. You're not paying the 5% either, and you're not paying residential rates. You're paying naught up to £150,000. It's 2% from 150 to 250, and then 5% above thereafter. So, these mixed use deals are very interesting.
Brilliant. Yeah, I think you've answered a couple of other people's questions in that case as well.
Oh,
is there a surcharge for mixed use property or non-residential property for overseas buyers, which you've just mentioned?
Yeah,
there's not, which is a great opportunity.
Yeah, so that thing about buying 6%, six properties together in a connected, two linked parties, all of that. Yeah, you don't pay the 2% surcharge for the non-UK resident surcharge.
Yeah, fantastic. Okay, cool. I think this one is more aimed at me. So the yields you've shown in the two examples at the end, does it include monthly installment, assuming it is interest only? So the numbers that I showed, the headline numbers I showed in those two deals are actually before, if there's any, this is a cash owned asset. If you was going to put a mortgage on it, then of course that would have to come out of the property. But then again, your return would move to more return on investment rather than net yield basis, because you're going to have less cash committed in the deal. But on a one-on-one basis, if you just reach out to me, you'll be able to we'll have a chat about that, and we can discuss various different things there on that one. Okay, just looking if we've got any other questions. So I think we've got another one about multiple dwellings reef. I think we touched upon that earlier. What planning strategies can overseas investors employ to mitigate the impact of non-resident surcharge?
Mixed use.
Mixed use. Yeah.
Or become a UK tax resident. But based on the number of non-doms leaving, I think that probably doesn't make a whole lot of sense.
The opposite way.
Yeah. So basically it's mixed use or property trader relief.
Yeah, for kind. Okay, cool. I think we've got a couple more. If you have a large portfolio, are there any exemptions that can be applied for stamp duty?
As a buyer, so if you've got a large portfolio and you're buying a large portfolio or you're selling a large portfolio,
must be buying, because of course if you're selling, there's no stamp duty.
Well, but with a vendor, one thing I would say is, bearing in mind, I've seen this a few times in various situations. So, for example, I've seen one vendor turn some land into a dog training area, putting a nice old lease in place, letting it sit for a while. Then the buyer goes and buys the whole lot with the lease. The whole thing is mixed use. Many hundreds of £1,000s of stamp duty reduced. So for vendors, it's, in my opinion, it's worth being literate on this kind of stuff, because if the buyer can reduce their stamp duty liability because of the characteristics of the property they're buying, just either makes it easier for you to get your asking price or quicker to sell it, just to say. Right, with portfolio, it's the 6 properties thing. So if you're the vendor, here's a good example. It's just understanding that this exists and then looking for buyers who might want to club together, and therefore the deal is you're putting less money into the tax man and keeping more money for yourself, basically. So it's the 6 properties thing, the 6 properties, and it's assessed as non-residential. Other than that, there are no exemptions that I know of. And I think I know the exemptions. And it was multiple dwellings relief. Now it's this. It was thrown out as a bone, as it were, to the market. But in practice, not many people buy 6 or more properties in one go. And you have to jump hoops to do that. So, yeah.
Okay, thank you. think I've got one last one, maybe two, but this one
Okay.
is quite interesting actually as well. I've heard you pay less stamp duty if you buy the company that the property is owned by rather than the property itself. How would that work? And is there an overseas surcharge if applicable?
Okay. Thank you for asking this question. I okay, so funnily enough, someone came to me asking about this the other day, and so I've done some research on it recently, just to refresh my memory on the whole thing. So I'll give you a little war story. I had a client some time ago, and they bought the company that owned the HMO, and therefore they didn't pay the stamp duty. And it's a very it it looks like a nice free lunch, in that the idea being that it's ambiguous. That's the first issue. So the way this should work, this group, it's called group relief. And the way it should work is that, let's say Matt here has a company and he's got various properties in it, and he wants to split things out a little bit. So he wants to move some property into a trading company and others into an investment company, just so it's tidier. So he sets up subsidiaries, two subsidiaries, and he moves a block of properties into InvestCo and the others into TradeCo. There would be no stamp duty payable because Matt would control all these different companies, and thus there's no change in ownership, and therefore, as I say, no stamp duty liable. But there's another scenario where Mr. Slippy decides to be clever, and what they do is they buy out the company that owns the property, and because they heard the group brief works, but what's happening is that they, in one sense, they're not transferring the ownership of the property, because the property stays in the name of Slippy and Co. Tax Avoidance Limited, but the ownership of the company changes, and this is where there are ambiguities. And the Finance Act 2003 tries to kind of clarify all of this. People do this, but on the whole, I would say tread with great caution. The guy I know who did it got away with it, but it's in the land of tax avoidance. In other words, there were these schemes that were around, more or less no more, but there were lots of these schemes like subsale relief, where there were mechanisms where you could create these structures or constructs, let's say, and thus avoid stamp duty. But the issue is that you have the law, and sometimes the law has ambiguities and has holes in it, and then you have the spirit of the law. And what judges look at is the spirit of the law. They look at the common sense approach to a situation, and they will go, well, based on this, you should do this, and therefore they issue their judgment. So this whole thing, if you're interested in doing it, maybe talk to me. We can go into it in more detail. But so I haven't finished my research on this. I've had someone talk to me and go asking me about it, and I sent them some stuff, but it's just, it feels to me, it's sketchy. It's trying to be clever, but it's not that clever. And the real clever part is picking your deals, working within the spirit of the law, and paying the correct stamp duty in the first place. So you're in an arguable position. That's clever. Everything else is not so clever, if that makes sense.
Yeah, thank you very much. Brilliant. I think that is all of our questions. So thank you very much again, Nick, for today.
Well, thank you.
It's been very valuable. I think everyone would agree. There's been a lot of information there that we can digest and certainly think about when we're looking at our deals. Like I said earlier, would highly recommend arranging a one-on-one call with Nick. Signing up to his newsletter. Nick, I don't know if you want to pop in the chat your website and potentially
Yes.
your details there. There's also on screen a QR code that if you scan that, you'll be able to register your details again for a consultation with either myself or Nick. And if you didn't get a chance to put in the chat earlier, yeah, thanks once again for attending. I hope it was valuable information, and we look forward to welcoming you to another webinar very soon.